Hello, welcome back again. A few days ago, I made a video about Best Buy, pretty much analyzing the company, analyzing the financials, and it came back to be a pretty interesting opportunity. I did want to see what's gonna happen after earnings, and earnings actually did happen, and so the stock price is actually up today at 9%. We will examine, of course, what happened and why. Because there are some interesting things to notice here. If we take a look at the stock news module of our tool, you will see a lot of things talking about Best Buy, which actually had a miss, it looks like here. Although I was looking at it from a CNBC article, which we're going to talk about later, and you will see that they still actually topped expectations, even though they had some loss. But this current environment, it makes a ton of sense. Now, you will see also that Citi cuts price target to $65 because Best Buy is not built for recession. This is something that actually Best Buy themselves said. And so Citi analysts see significant risk. Now, I don't pay close attention to what analysts say. I actually probably pay no attention at all in terms of their buy or sell suggestions. But it's interesting to at least take a look at that, and you can see all sorts of articles talking about a potential recession or inflation that could be problematic for Best Buy, and that is indeed the case. But there is always a price to pay, and potentially even take a little bit of risk and let it grow through the years if the company is solvent, if they have good cash and actually can sustain some pressure, withstand some pressure while we are potentially may have a recession. Will we have a recession? I'm not sure about this. I don't see it myself. I mostly see this kind of happening right now with the stock market, this kind of crash, almost as if it's a correction in terms of prices. But I don't really see an environment where people will actually stop spending and there's going to be a massive recession. We'll see, of course, because it really depends on politics as well. Okay, so before we jump into the financials and just examine them a little bit again, because we're having a new price now, we're sitting at $80. And remember, actually, Citi actually brought it down to 60 something. You will see here that Best Buy says softer demand is sticking around, but company isn't planning for a recession. So they do expect softer demand, and that makes a ton of sense. I mean, this is exactly what the Fed is planning for. They want to decrease demand, they want to decrease inflation. And so revenue declined but still topped expectations, and same-store sales fell by 8% versus the year-ago period, a better performance than the 8.6% drop analysts projected. Now, same-store sales is a very important metric because there are multiple ways to increase revenue, and so it looks like sales may have increased, for example, opening up new stores or revenue that doesn't come from these kinds of sales. And it is problematic to have something of that sort, and this is why this kind of number, the same store sales, is super important, because this is about the stores that have been operating for more than a year, and it tells you whether there is a drop in the sales, the revenue that the company generates from these stores. And there is a drop, which is expected, though, again, in this current environment, and it was actually a little bit less than was expected. And so it's important to know this figure, like the same store sales. And the article starts with that, which makes a ton of sense here. Now, what happened? Best Buy reported lower sales for its fiscal first quarter, and so they cut the outlook for the year as well, citing software demand that's expected, of course. So that trend has continued in the beginning of Q2, it looks like. So they don't see it stopping in the very near term, but yet they are still not planning for a full recession here. Is what the company said. Now, earnings per share were 1.57 versus 1.61, which was expected. So it is a little bit worse than expected. Revenue 10.65 versus 10.41, which is better than expected. And they anticipate a full year revenue ranging between 48 and 49.9, almost 50 billion here, compared with a prior outlook of 49.3. So this is actually probably a little bit better. Actually, no, it's actually a little bit worse than expected. Now, same-store sales will decline between 3% and 6%, a bigger drop than the 1 to 4% decrease in previously forecast. And again, this is something that is likely to be expected because of the current environment. And this is why you could have had an opportunity of buying this at a cheaper price as it was going down. Of course, this pressure was mounted to the company and the stock price pretty much before this earnings. Now, looks like things were better than expected, and now we're seeing the company stock price climbing up higher. It may be though that at this current environment, maybe it will actually fall back a little bit. Who knows? But the thing is, you are seeing here that the company will have a little bit of a little bit of a worsening in terms of its financials, yet they are doing well overall, and we will examine some of the details after we're done with the article. So Best Buy's quarterly net income fell to 341 million, or 1.49 per share, down from 595 million, or 2.32% per share. So this is a pretty important, pretty steep drop here. So net sales fell to 10.65 billion, also from 11.64 a year earlier. Now, I want to be, of course, the article continues with some, some things here like more promotions for your employees. It's the usual stuff that you would expect in this kind of environment, and it will happen with all sorts of retailers. There is going to be a general decline in the economy in terms of these kinds of stores, which is why it may be an interesting opportunity again to buy at some point. Although, you may want to wait it out a little bit, or you may want to have bought it at a cheaper price, is the thing. And so is this price still relatively cheap? $80. So again, if we take a little bit of a closer look at what the company has been doing, let's take a look at the max chart, and you will see that it has a little bit of a decline here, and it has been a high flyer, of course, this company, and it is a company that is selling a lot in the US. And right now the P ratio is still rather low, 8.82. 716 is the price to free cash flow ratio. These are low numbers, but remember, it is a retailer, so you could expect and you should expect low numbers. They have been buying back shares like crazy here, which is fantastic for stockholders of the previous years. And they have a free cash flow of last year that is about 6 years of free cash flow, this free cash flow to pay back all the total liabilities that the company has. A little bit more than I want, but still fair. And the company's revenue hasn't been growing tremendously, of course, and net income though has been doing much better with a free cash flow, and total equity growth has been going down a little bit because of debt. And this extra debt increases the returns on equity. We have talked about this concept many times in the past. But look at this dividend yield, 3.7% is the last 12 months one, which is 26.7% of the free cash flow that the company generates, which is amazing. This is very low, so it's a very safe dividend. This is one of the things that I really like about this company. I'm not a huge fan of dividends. I have explained why in the past, because they are not tax efficient, they are tax inefficient, they are double taxed pretty much. But the effective dividend yield based on the current price is 4.4%. This is the 12-month one. So if you buy the stock now, you're getting 4.4% on your money, which is pretty great and pretty safe as well, pretty secure based on what the company has been doing. Why it is secure? If you take a look at the cash flow statement here, you will see that the company generates 2.5 billion in free cash flow. Yet last year they paid 688 million in dividends. So this is a very low amount, very low amount in terms of the free cash flow that the company generates. So they can very easily pay this dividend without having to drop it at some point. And actually last year their free cash flow was even more than this, so we were looking at an even lower free cash flow payout ratio, which is fantastic, because even if the company has a period that's not going to be doing great, they will still have the cash to pay the dividends back to people. And so even if the stock price goes down for a while, they will still be able to pay the dividends. And you will look also at here and see that the company has more cash than what they had a few years ago, yet they have still bought a lot of shares back. Remember that. They have been repurchasing common stock like crazy, 3.5 billion here, 1 billion here, 300 million, 1.5, 1 billion again, 1.5, 2 billion here. So pretty much repurchasing common stock pretty much every year, a lot of common stock. I love to see that. This is great stuff from the company. And yes, okay, there may be a little bit of a downturn, but again, it really depends on what you are buying and for how much you are buying something. And so a revenue of 42 billion, 51.7 here, increasing its revenue, increasing its net income. Balance sheet that is going a little bit down here, but this is to be expected because the total liabilities have been going up quite some because the company has been getting debt. The thing is, the company can easily service this debt. Again, if you take a look at the total debt that they have, 3.8 billion, and then go back to our cash flow statement, you will see that they made 2.5 billion. So in like 2 years of free cash flow, they can pay back all their total debt. And also, if you take a look at the total liabilities, which we examined earlier, we talked about it earlier, that's 14.4 billion. It would take them about 5.7 years. We already saw that in the tool, remember? 5.7 years to pay back all the total liabilities that the company has. Let me actually take you there so that you can quickly see that. So 5.7 years, yes. Okay, so we are looking at a company that is very interesting to me. I mean, I like what I'm seeing here. I liked it in the previous video as well. It's completely irrelevant to me that the price is up. I'm actually worried about this. I don't like it. I would prefer it to go down, frankly, after earnings, so that I can buy at a lower price. But let's examine the valuation tool and see what kind of price to pay for this one. Now, the revenue growth has been 6, 1, 1, 8, and 9. I'm gonna go low and see what we're getting out of this one. 1, 2, and 3 is what I'm gonna do, because we may see a little bit of a suppression in terms of the revenue growth again at this current environment. And net income margins, you will see here 2, 3, 3, 3.8, 4.7. I'm going to go something like 2, 2.5, maybe 3, and 4. Let's do that. 2, 3, and 4. I think makes sense. 4 may be a little bit of a stretch, but they did do 4.7 last year. The free cash flow margin over here, we're going to go with something near 100. That makes a ton of sense for this company. Let's go 90, 100, and 110, which looks more closer to what they are doing. And 13% for an annual return here. And if we hit calculate here, you will see that our low price is sitting at 57, and I would love to be able to buy this at a low price. Before, in the previous video, this would have been at around 74 bucks or something, 73. So we would be closer, but we are still in the green for our medium estimates and much in the green for our high estimates. And remember, the green estimates here, it's just a revenue growth of 1%, which the company has been doing pretty much every year since 2018. And the net income margin of 2%, which is also very, very low. Every year the company has been doing significantly more net income margin. So probably 3 is the lowest that makes sense really in terms of net income margin, practically speaking. And I think this estimate is the closer to reality. And because this company again is a company that is paying a safe dividend, if you are an income investor, if you actually prefer to be getting paid and you don't really mind the tax inefficient part of it, and also buying a company that is cheap, this is maybe an interesting opportunity. Now, you know me, I love cheap prices. I would have loved to buy this after a massive drop. It didn't happen. It may happen, who knows, maybe later if the crash continues in the markets. But I do like the company and I do like the price, even at its current valuation. It may be an interesting opportunity to start buying a little bit and see where this takes you. And yeah, I mean, it's a good company, very, very good company. And frankly speaking, yeah, I would definitely consider adding to my portfolio. It is a little bit of a weird environment right now. Yes, inflationary. You may want to wait it out a little bit and see again if you can get that at a little bit of a better price. Just because we're seeing inflation, a lot of inflation, we're seeing interest rates rising. So you may be able to get these kinds of retailers at a better price a little bit later potentially. But worth keeping it in mind. Very interesting company. Cool stock, which is not overvalued, it's actually undervalued. So very, very good one to have in your watch list for sure, or potentially even buy today, really. So thanks for watching the video. I hope you liked this one. Please remember to leave a like and subscribe. And remember, you can always become a Patreon and get access to this tool and do all this analysis that I did for you here on your own for any stock that you want. You can find links in the description box below if you are interested, below this video. And also join us in our Discord channel. We have a lot of people talking there. We have a lot of discussions. It's cool, very cool. And we're having some very, very nice talks there, some very, very nice discussions. And we'd love to have you around. So, thank you for watching this video and I'll see you in the next one. Bye-bye.